The Fed is putting the housing market in serious jeopardy right now. Although we're showing some progress on fighting inflation according to the latest reports, the Fed is still acting very tough and indicating that they are not going to let up whatsoever. Now, some people on one hand believe this is just an act and it's really just a matter of time before the Fed pivots, whereas other people are in the camp that they've been seeing the Fed do recently what they say they're going to do, and so they really believe they're going to stay aggressive with their monetary policy throughout the rest of the year. Regardless, this is having a huge impact on the future outlook of the housing market. I'll explain why that is in today's video, along with why the Fed is leading us into an economic recession and why they're putting the housing market in serious jeopardy right now. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. The housing market is in serious trouble right now, and largely because of the Federal Reserve. Now, we already know that the Fed has been very aggressive with their monetary policy. They've been raising their rates for close to a year now, and that in turn has caused mortgage rates to go up as a result, but that's not what I want to talk about in today's video. You see, today what's on most people's mind is simply surviving at this point. I'm talking about cost of living. I'm talking about inflation concerns, and most importantly, concerns over the future of an economic recession taking place. Now, all of this is significantly impacting the housing market, and particularly what we've been seeing is, as a result of these concerns, we've been seeing buyer demand continue to plummet, and we recently saw that mortgage purchase applications have reached the lowest levels we've seen since 2014. This is a reflection of where buyer demand is currently at, and we're seeing that mortgage purchase applications continue to decline as they've gone down 1% over the last week, but that follows the previous 2 weeks where we saw an additional 12% decline take place. And if you're to take a look at the year-over-year numbers, we're actually down 44% year-over-year as far as purchase applications are concerned, and that is a massive drop to take place in just 12 months' time. Now, we've been seeing this affect the amount of housing transactions take place, the amount of sales taking place throughout the housing market, as we saw existing home sales plummet to the worst levels we've seen since 2010, and pending sales came back at the second worst levels that have ever been recorded according to the National Association of Realtors. We've also already seen home prices decline over 10% from peak levels, and this has largely been due to buyer demand plummeting as mortgage rates have become much higher, and of course affordability as a result has plummeted, and so more and more buyers are pulling out. And even though we've recently seen mortgage rates retreat recently from about the mid-7s to the early 6s, we continue to see more buyers exiting the housing market, mainly over concerns over the future of the economy. It's a very real concern for the average American, and you see the big picture here is the Fed has been raising interest rates in order to fight inflation, and their goal has been to bring inflation down to ultimately these 2% levels. Well, just last week we got another positive inflation report back, and by positive inflation report I mean that we're doing really well in terms of bringing it down at least to expectations, or even better than expectations. This was the third positive inflation report in a row that we've received. So far we've been able to take inflation down from the highs we saw in June of 9.1%, now down to 6.5%, and even better than that is on a month-to-month basis, we saw our first negative inflation number, showing a growth of negative 0.1% month over month between November and December. Now, the Fed also particularly cares about core inflation, even more so than regular headline inflation, particularly because of the lack of volatility you experience with the energy side of things, especially with gasoline prices that we see are very volatile with pricing. They can kind of manipulate the inflation numbers a little bit, and so even in core inflation, we've managed to see it come down from a high of 6.6% in September, now down to 5.7% in December. So with this positive inflation news taking place, there were many investors that believe that we may see the Fed do some sort of pivot, not in the sense of a rate cut, but more in the sense of a pause, maybe no more rate hikes from this point on. Now, I don't personally believe at this point that's going to happen, and this is mainly because the Federal Reserve continuously keeps reminding us that they are going to stay aggressive with their monetary policy throughout the rest of the year. They're not going to stop the rate hikes. They're going to continue. They may slow down the rate hikes, but they're still going to hike interest rates from this point on. And all the Fed members even said, do not expect any rate cuts to take place throughout all of 2023. Now, regarding that, there's good and bad news about that. The good news is that, of course, inflation is very likely to be solved at this rate, because despite the fact that we're making some good progress on it, the fact that they plan to stay ultra aggressive with their monetary policy, it's very likely we're going to accomplish what we're looking to accomplish with inflation. But the question is, at what cost? And the answer to that is likely an economic recession, as long as the Federal Reserve sticks to the script. Now, an economic recession is certainly going to have a negative impact on the housing market, and Jerome Powell doesn't really seem to have a problem with that, as he readily admits to expect a difficult correction in the housing market. Just check out what he had to say to reporters back in September. You can see when he was speaking to reporters in September, Fed Chair Jerome Powell was asked to clarify what he meant when he said spiking mortgage rates would cause a housing reset. The meaning, he said, was that the U.S. housing market would slip into a difficult correction. When I say reset, I'm not looking at a particular specific set of data. What I'm really saying is that we've had a time of red-hot housing market all over the country, where famously houses were selling to the first buyer at 10% above the ask, even before seeing the house. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford housing again. So ultimately, Jerome Powell is quite okay with a housing reset taking place, with a difficult correction taking place, and that is going to be one of the costs of an economic recession taking place throughout the country. So at this point, what we're seeing is that people are very aware of what's coming up, because it's literally all over the news. I mean, you're seeing reports everywhere about a housing market correction or housing market crash. You see reports about mortgage rates being sky high, housing unaffordable, and an economic recession being on the way. So many of these potential home buyers are aware of this, and of course they're reaching this point of capitulation and they're backing out of the housing market big time. Now, I've already talked about buyer demand reaching these 2014 lows with the purchase applications going down, but in addition to this, it's also affecting the new construction side of things. You see, KB Homes, which is one of the biggest builders in all of America, they just announced that in the fourth quarter of 2022, they saw cancellation rates for their houses jump up to 68%. Now, I want you to think about that for just a second. That means that more than 2 out of every 3 people that are under contract to buy a house are backing out of their contract. Now, to add some context to this, if you were to go back just 1 year ago to the fourth quarter of 2021, that number was only down to 13% of home buyers canceling contracts. And even if you just went back to the third quarter of 2022, just 1 quarter before, that number was sitting at 35%. So we've seen it in 1 quarter's time jump from 35% up to 68% of people backing out. So based on those numbers, it's pretty clear that right now there's a lot of concerns with home buyers over the future of the economy. In fact, this is what KB Homes had to say in regards to their cancellation rates jumping up so high recently. They said that current conditions remain challenging. High mortgage rates and persistent inflation, together with an uncertain economy, have made home buyers more cautious since the middle of last year. So again, they're talking about inflation, they're talking about mortgage rates being high, and they're talking about the state of the economy being a concern. Now, of course, 68% sounds like a big number as far as cancellations are concerned, but how does that compare to something like 2008? Well, to put it in perspective, back in the 2008 housing crash, the average builder cancellation rate we saw was coming in at 47%. So that is a long way from the 68%, which is clearly a substantial number we're seeing right now with KB Homes. Now, how does this ultimately affect the housing market at large? Well, builders like KB Homes are put in a position to where they're going to have to up their incentives. They're going to, more importantly, have to slash their prices even more because they are some of the forced sellers within this upcoming recession we're seeing. They need to offload their inventory. And so for them, the sooner the better because they'd rather sell it now versus selling at an even bigger discount down the road. So they're going to have to continually discount their properties and continually up their incentives in order to offload their inventory. Now, this is exactly what I've been talking about on this channel for a while now, about how builders are some of the forced sellers within this economic recession because they have to turn over a profit. It's how they make their money. Unlike the average homeowner is not forced to sell their house. They can just choose to wait it out and wait for a better time to sell their house. So the thing is, as these builders continue to sell at a discount, that's going to create brand new comparables that are going to be the standard for that area. And imagine an existing home that's maybe a little bit older but a similar size house in that area that can't sell for more than a brand new construction is selling for. So as these houses that are new construction are going down in value, that affects what the prices of these existing homes are also going to be able to sell for. It affects the housing market at large in that area. Now we'll have to see if the Federal Reserve continues to stay the course with their plan, but at this rate, if I was to bet on it, I would bet that they probably will do it at this point. They seem to be very adamant about it. They seem to be backing it up with action as of recently, and they don't seem to be very swayed with a housing market correction, as they seem to almost want that to take place to make housing more affordable for the average American. So with that said, I'm going to continue to keep you updated on the latest with the housing market, what the Federal Reserve is doing, what's going on with the economy. And so if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.